In this video, we're covering one of the most influential concepts in investing, the modern portfolio theory, or MPT for short. Developed by Harry Markowitz in the 1950s, MPT has been guiding investors for decades. It's a Nobel Prize winning framework that helps us make smarter investment decisions, balancing potential returns against the risks that we take. We'll break down the fundamentals, practical applications, and give tips on implementing this approach in your portfolio. To start, let's look at the essence of the modern portfolio theory. It's a mathematical framework that helps investors construct portfolios that aim to maximize returns for a given level of risk. It's based on the simple but powerful idea that risk and return are linked. In practical terms, this means that instead of betting on individual stocks or trying to predict market ups and downs, the modern portfolio theory encourages us to build a well-diversified portfolio. And by doing this, we reduce our exposure to the risk that any single investment might underperform. And that's a game changer. There are a few key principles within the modern portfolio theory that we'll want to understand. So let's break these down. One core concept in the modern portfolio theory is the direct relationship between risk and return. Investments with higher potential returns often come with greater risks. The modern portfolio theory helps us understand and manage these risks by categorizing them into two types. Systematic risk, also called market risk. This is the risk tied to overall market movements, like economic downturns or interest rate changes, and it cannot be reduced by diversification. On the other hand, unsystematic risk, or diversifiable risk, is the risk unique to specific companies or industries. And the good news is that we can reduce this type of risk by diversifying. Diversification is a key tool for managing risk. When we spread investments across different asset types, sectors, and regions, we reduce the chance that a single market event could negatively impact our entire portfolio. The modern portfolio theory takes this a step further, suggesting that we choose assets with low or even negative correlations. In other words, assets that do not tend to move together. So if one asset takes a hit, another might hold steady or even rise, smoothing out your overall returns. The efficient frontier is a curve that represents the set of optimal portfolios offering the highest possible return for a given level of risk. Portfolios on this curve are considered efficient, meaning they strike the best balance between risk and return. The modern portfolio theory aims to position your portfolio on this efficient frontier, so you're not taking on any unnecessary risk for the return that you're targeting. Now that we know the theory, let's see how to apply it. Asset allocation is about deciding how much of your portfolio goes into stocks, bonds, cash, and other assets. By strategically allocating your investments, you control how much risk your portfolio takes on. For example, stocks and bonds often have a low correlation, meaning they don't always move in the same direction. Pairing them can help stabilize your returns over time. Within each asset class, further diversification can be achieved by spreading investments across asset classes like equities, bonds, real estate, and commodities, geographic locations like domestic versus international markets, and sectors like tech, healthcare, and energy. Now, this layered diversification lowers the impact of sector-specific risks on your portfolio. One concept that the modern portfolio theory brings to the table is risk-adjusted returns. The Sharpe ratio is a common way to measure this, comparing an investment's excess return to its volatility. A higher Sharpe ratio means a better risk-adjusted return, so it's something to keep an eye on when comparing investment options. Using the modern portfolio theory, we can follow a portfolio optimization process, choosing assets to achieve the highest expected return for a certain level of risk. This involves analyzing the expected returns, volatility, and correlations of each asset, then using mathematical models to identify the ideal portfolio on that efficient frontier. It sounds complex, but nowadays, there are tools and software that handle much of this heavy lifting for you. So, why bother with the modern portfolio theory? Here's what it offers: risk reduction through diversification, optimize returns based on your risk tolerance, helping you avoid taking on more risk than what you need, a scientific approach to investing, which takes emotion out of decisions, and a more efficient portfolio management by focusing on the right asset mix rather than individual stocks. Of course, no theory is perfect, The modern portfolio theory assumes markets are efficient and investors are rational. But we know markets can be unpredictable, and investors can certainly act irrationally. There are also real-world constraints like taxes, transaction costs, and liquidity that the modern portfolio theory does not fully account for. To address these issues, newer models like the capital asset pricing model, CAPM, and arbitrage pricing theory, APT, have been developed. These models build on the modern portfolio theory by adding more layers to better reflect market realities. Ready to put the modern portfolio theory into action? Here's a simple roadmap. First, assess your risk tolerance and goals. Know what you're comfortable risking and what you hope to achieve. Then determine your optimal asset allocation based on these goals. Diversify across asset types, sectors, and geographic areas. Monitor and rebalance regularly, especially as your situation or market conditions change. And with today's tech tools, like Range, you can automate a lot of these processes. Platforms like Range use advanced algorithms to optimize portfolios, making this approach accessible to more investors than ever. The modern portfolio theory provides a solid framework for building efficient, diversified portfolios that match your risk and return preferences. Whether you're new to investing or just looking to optimize an existing portfolio, the modern portfolio theory can guide you towards smarter, more balanced decisions. Thanks for watching.